Are you ready?
Ready.
All right, let's go. Kevin here, top 1 financial advisor and best-selling author. We are here to talk about the stock market. Every month, I host a call for my students inside the Investor's Toolkit. The Investor Toolkit is my premier course offering. We go through my entire 7-step investing process. And essentially, I give you everything I know over my 12-year career as an advisor and as an investor and put it all into one course. And again, every month we sit down and talk about, and it's a live call by the way, we sit down and do a Q&A. Here's what's going on in the market, here's some things I'm expecting, here's what I'm considering investing in, and then they get to ask questions about what is going on in their portfolios, what to do, what not to do, and I give my thoughts and opinions. Now, in last week's call, Sunday's call was the last time we had it. For this month, the question was, what are some ETFs that we should talk about? What are some ETFs that should be on the radar and some things that might be investable? And as I started to do my research for this, it was kind of difficult because the market is down. Now, remember, an ETF, for those that may not know, is an exchange traded fund. It is a basket of stocks packaged together for you to invest in. And the benefit of that is, number one, you're more diversified. You don't have to say, I'm writing on this one stock and I hope that it does well. For example, for me, I chose Danaher, that's DHR, that's one healthcare company. Looking back on it this year, I should have chose AbbVie, right? Now, I've had Danaher for a few years now, so I'm more of a long-term investor. I'm not judging it on 1 year. However, that's a risk. What if I could have owned all of the healthcare companies and had them in one nice, neat package? How would that have played out for me? Okay, so that is the advantage, and they're usually very inexpensive in terms of the cost and fees that you would pay for any of these ETFs. So before I go into this, I want to talk about context. Remember, the stock market is down, depending on when you're watching this and how the market is moving. I'm doing this during the day, is around 19%. Let's call it negative 19% right now. So anything better than that, including negative 10, is still better than negative 19 or negative 20. Okay, so remember context here. The other thing too is that some of these, I'll talk about one that's down about 3%. That's something you can make up pretty easily if you time your entry correctly, depending on whether or not you even want to look into it. So I do want to emphasize context. The other part is that in a market like this, ETFs are a little bit more disadvantaged. So for example, let's say I'm going to talk about healthcare. There's one healthcare ETF that we're going to discuss here is this. If I have AbbVie, right? AbbVie was up whatever day we recorded that video. We talked about it briefly. It was up double digits. That's one company out of, let's say, 100 in the entire ETF. Well, if that's the case, you got 1 versus 99. If those 99 are negative, it ain't gonna help you, right? So you spread out your risk, but that's not gonna help you in a year where the entire market is gonna be down 20%. Therefore, the majority of all stocks are going to be down. So it's a little harder for ETFs to succeed in an environment like this. It's always, high risk, high reward. And when you lower that risk, you lower that potential reward. So if I were to put everything on one particular company, it would probably do better than all of the ETFs I'm going to list. But again, you are lowering your risk here. And by doing so, you are lowering those returns just a bit. However, the comparison here, right? I may lower those returns, but if it's still better than what we see right now in the market, when you're flirting with bear market territory, depending on the day, it is still a good thing. So I want to get all that context out the way, give you realistic examples for what is going on in the market, and not, sell you hype of some super risky thing that's out there. But these are good quality ETFs, and let's go ahead and jump into it. All right, so the first one is the healthcare sector ETF. I've been talking about health for a little bit. And this one is XLV. This is not BlackRock's. I think it's by SPDR. That's the company that manages this one. And obviously it has a lot of healthcare companies, primarily in the S&P 500 index. So you got the entire S&P 500. They zoom in and do everything in the healthcare space. Healthcare is one of the few areas outside of energy that has done well this year. In the last 6 months, this one is down negative 2.88%. Okay, not great. But if you were going to choose, would you rather lose a small 3%, which in theory could be made up within a day? Or would you rather just take the entire stock market and be down 20%? you choose. Now, that is not to say that you should get out of your S&P 500 index funds. I'm not saying that at all. I'm not selling any of my index funds. I'm just saying, if you knew this going in, we'll take a 3% hit. That is, again, you can time this right and be fine. I'm sure, I can almost guarantee there's somebody who invested in this one and it's still positive, just depending on the time and date that you got in. So that's one of them. The next one here is the only one that is positive, and perhaps I should save this one for last, but this one is the Vanguard Energy ETF, and it is VDE. In the last 6 months, and this should be no surprise, in the last 6 months, this one is up 10.19%. Here's what I wanted to hone in here when I talk about risk versus reward. I talked about oxypetroleum the other day, and as of yesterday's video, because we had talked about it for Warren Buffett, it's that one company, oxypetroleum, is up 70%. Stuff like ExxonMobil and others are up 40, sometimes 50%, depending on when you're looking at it. Well, this ETF, which has most, if not all, of those companies in it, is only up 10. I have spread out my risk. I have lowered my potential reward, because again, you could also have something that's down negative 50% as well. So it really takes everything and averages it in, and again, lower risk, lower reward. But again, that risk part of it, if you didn't have Oxy and you chose something else, might not be so nice for you. Right, so you're really finding a middle ground here. But anyway, or in any case rather, if the market is down 20%, I will gladly take the 10. So this is one way, if you're into energy, if that's a place that you want to be, that is something to at least consider in a market like this. Being green at all is a success in this year so far in this case, and this one being up 10% is definitely something to at least raise an eyebrow if you don't have any energy exposure, or if you're at least interested in it. Now, I have said this, and it's the exact same thing for Oxy, is that gas prices have come down. And if you look at the chart very closely, you'll see over the last 30 days or so, as gas prices have fallen off, this one has slowed down a bit. If I did this video a month ago, it would be, and I'm eyeballing it and looking at the chart, it obviously would be more than 10, but maybe it's 15, closer to 20% gains versus what it is right now. So it has come off of its high. I don't know where gas prices are going. I would prefer them to continue falling. I think we all would. But I just want to throw that one out there. I don't know. I can't sit here and tell you whether it's going to be too late or if it's early or whatever it's going to be and where this particular one is going, because oil and gas prices and just energy as a whole is a very different market. It is not super simple because of how the oil market is comprised and the difficulties in economics when it comes to oil. Not to mention that Russia and Ukraine, while it may not be dominating the headlines, is still a thing, and it is still impacting this particular sector. So it's up now. I don't know where it's going. It's one that I personally would not invest in because of how I feel about oil and the conflict, but also how complex energy is. I've never been someone who invested in energy. Maybe that's just a default from being from Oklahoma and knowing those boom and bust cycles. Maybe it's just me, but that's a personal bias that I'm admitting. You make your own decision, okay? All right, so that was 2 ETFs. Let's move on to the next one. We have the Consumer Staples Sector ETF. This one is XLP, and it is down 3.71% in the last 6 months. Again, 3% is solid in a market like this, but I have been saying, like, hey, in a space like this, you got to watch and see. But it does have a lot of companies that I like, including Costco. Costco I've been saying this for at least 2 years, one of my favorite stocks out there. Even though a company like Costco is currently down, it's still one that I'm holding for the long term. Costco is down way more than 3% this year, or almost 4% in this case, but it's something that tends to be a bit more defensive. In an up market, you're not going to make a whole bunch of money, but you can see in the down market, it is really protecting you compared to what the market is doing as a whole. So again, you get lower risk, lower reward here, but for the defensive factor and probably for the dividends too, this one's actually a pretty solid one. let's say the market is up in 2023. I don't know that to be the case, but if it is, this is not a place I would just clamor to, because again, the consumer space in most areas doesn't grow like an Apple normally does, or like an Amazon normally does. It's something that's just super steady and consistent. If you're someone who's risk averse and you say, look, I just need something that I know is going to be there, I know something that's not going to go out of business, this could be one of those spaces. If we go into a recession, and if inflation plays out the way we expect it to, or the way it continues to play out, perhaps this one will improve a bit. But again, down 20% bear market, or I just want to take a smaller hit of the 3.71. Probably take that if I'm looking for a new ETF here. Now, one that is probably the most interesting on my list here, at least in terms of name, I'll say in terms of name is interesting, is a Schwab US dividend equity. So this is equity stocks that have good to solid dividends. This one is created by Schwab. Its symbol is SCHD. Now this one is down 10.32%. Which again, I gotta continue to emphasize this, because normally this is not a day that, or a channel rather, where I tell you, hey, here are all the stuff that's negative, okay? But in context, in a year like this is one of the only times you will likely see it, at least hopefully, because that would mean the market is up. But again, this is doing twice 50% better, I guess, than where the market is. So if the market is down 20% and you're doing 50% better, I guess that brings you at 10. Y'all can check my math on that, but I think that's how it works. But in either case here, they're down about 10% over the last 6 months. They invest in high quality US companies that pay solid dividends, which I know a lot of y'all like dividends. I think everybody likes dividends. I'm someone who likes it, but if I don't get it, I'm not going to be upset. So the good thing here is that it is somewhat offset by dividends. So in real terms, in terms of how the price movement of this particular ETF has moved, it is negative 10%. When you factor in dividends, you're probably going to get a bump of at least, I would imagine, 1 to 2%. That doesn't mean that you should just pile into it just because, but if you are someone who's looking for solid returns, you're looking for a decent dividend, and you're not trying to go through and choose individual companies, then this might be something for you. Personally, if I'm looking for something that's solid and is going to pay me a dividend, I'm going to go with Coca-Cola. I just think that's really easy to do versus doing something like this. And Coca-Cola, last time I checked, was up, I think it was like 6% or so on the year. And that was last week. Things have obviously changed, and the market's up today. So Coca-Cola could even be doing better at this point in time. But again, I'm taking a higher risk by putting everything in Coca-Cola than taking a lower risk by putting everything into this particular ETF. So those are some of the best ones right now. Again, I know that all but one of these was negative, but I'll run through these one more time. You have the healthcare sector ETF. That one is XLV. Then you have the Vanguard Energy ETF, which is the positive one, the one that is doing the best right now for obvious reasons. That is VDE. Then you have the third one, that is the Consumer Staples ETF. That one is XLP. And then the last one we have is the Schwab US Dividend Equity ETF. That one is SCHD. Now, last thing I'll discuss is this. If you're looking for something, let's say you're looking for something for the long term, you want to get something that's solid now and hold this for, let's say, forever. We said long term, we're just going to stick with long term. Number one, you still have your VTIs of the world, Vanguard Total Stock Market Index. That's going to be down now. It's going to do whatever the stock market is going to do. I still think that is always going to be, especially for a new investor, I think for everybody, a core holding. Okay, I'm never selling something like that. That's just going to be there, right? But if I want to do something slightly extra, if I'm looking for dividends, take a look at that Schwab one. If I zoom back and say over the last, let's say, 5 years or something like that, this one does perform pretty even with VTI, and again, might get you a little bit of a better dividend. So just keep your eye there. But those are, I would say, my top 4 right now that are good to solid. But again, this definitely depends. It always depends on what the stock market is doing right now. If you've got some that are good to solid, let me know in the comments below, because I looked and just couldn't find a whole bunch in the green that weren't. I could have done a list of all energy ETFs. Yeah, I could have did that, but we know where energy is right now. We talked about that many times before, and I've already listed one here. So if you find any others, I am very, very curious to know what your thoughts are. Last thing, as always, make sure you check out the members only. I'm dropping a new video tonight on the 13F to discuss where and how you can find out where super investors like Warren Buffett, where they're putting their money, how you can break down those reports, and how you can use that to perhaps inform your investing strategy. So make sure you check that out. Last video we did will be here, and I think I don't know if we're up to 5 or 10 videos now, but again, at least once a week we add a new exclusive video. I have some more company breakdowns that we're going to do. When y'all ask for something, it's going to be, if one of the members asks for something, we're definitely doing a video on it, and I give you greater level detail into all the things that go behind a lot of stock picks that we talk about, and a lot of topics that we discuss. So make sure that you join that. The link, the videos, all those things will be in the description below. All right, that's it for me. Talk to you later.